Hello fellow traders, welcome to another episode. Thank you for your support. Today we have a big tutorial episode. If you are already advanced, you are not going to need this, but since we have a lot of new traders in this channel and most of tutorials are for them, let's see all candlesticks charts that there are out there. You don't have to remember them. They are not 100% accurate. We have analyzed that in our series. There are sites that you can automatically see and they can automatically tell you the formation at any given time frame if you choose, for example, an asset to trade or a stock to trade or a binary options. They will automatically pop up and they will inform you what is the relevant formation and in what time frame. So you don't have to worry so much about learn all these patterns by heart. Remember, this would be a very big episode, but if you are beginners out there, it's very good to give it a look and understand how and the logic behind each and one of them. I will give explanations about all of them. I think they are about 30 in this video. We won't see advanced pattern formation in this episode. There are other episodes in this series that you can check them and they are far more advanced. Of course, again, it doesn't mean that they are always working. They are very helpful if you want to have a signal in your strategy or if you want to increase your strategy. For example, if you see bullish engulfing or bearish engulfing candlesticks, it means that it probably might be a good signal to enter in a long or a short position. I have all spot them in real markets. This video will be paused many times. And let's start. I have spot all of them in real markets to make it easier for you. And now let's see the two of our basics. A bullish engulfing and a bearish engulfing candles. I have spot them here in real markets. Bullish engulfing and bearish engulfing. That's why I have used the colors. Green it's when the prices goes up, red when the prices goes down. Remember, both rules apply even for an engulfing that goes up or for an engulfing that going down. They are both give signals that the market will probably go up or the market will probably go down. The more intense, the bigger the body, the more intense, the bigger the move. Either to the upside, either to the downside. Now, the same exactly rules apply for both situations. Let's see and let's zoom in by changing the time frames. I will go to the 30 minutes. And this is the green area of the 4-hour candlesticks. Now, what does it mean an engulfing 4-hour candlestick with a big body? It means that for 4 hours the prices were going up, but if you go deeper in the time frames, now remember we are in the 30 minutes, so we need a couple of 30 minutes to form a 4 hours. We see that the prices weren't exactly going up directly. The half of the period, let's say, the prices were remaining at the same spot, and then suddenly the prices shoots up. The same also, if we go to this, we will see a different formation to the downside. Let's say for one period the prices, for this period the prices start immediately going in the downside. That's why it's you need to understand the logic behind any formation. For this bullish and bearish, when we have a bullish engulfing, the market indeed moved to the upside. Let me switch, and we have bearish engulfing. Indeed, the market keep going to the downside. Again, it doesn't mean anything. They are just signals that you will use in your trading. Now let's move to the next one. Here we have the 3 upside down. This consists out of 3 candlesticks after a bullish momentum of the market. It consists of 3 candles. So we have the first one with a big body, and now the second one gives it's much it's an engulfing candle. All the prices of the first candle contains inside here in the second one, so it means that the prices moved up but eventually lost the entire momentum for the period. And not only that, but the prices went even lower. And this is the third, the confirmation candle. So the three upside down consist out of these three candles, two engulfing candles to the downside and one to the upside. The doji candle, this is a very specific one. You will see it many times. The price, the open price of the candle and the close price are almost the same. It is a candlestick that doesn't have a body. This means indecision in the market. Out of all the candlesticks that we describe, you're gonna notice this one. It might help you, giving you a signal at a point if you want to go long or short. This signifies that there is indecision in the market, because in the opening the prices travel until here, they went down, so eventually they came out with the same price. This means indecision in the market. Spinning top, the same with the previous one that we check. The prices, it's a single candle. The prices goes in, travels until this point, goes back down, and now the exit point consists of a body. It's the same as the previous one we check. It means indecision in the market. Most likely the market will reverse either to the upside, either to the downside. Always keep in mind that we are this visual representation of the candlesticks might be completely different. The main idea is that the prices looks balanced either to the upside, either to the downside. For the next two, we have the falling 3 method and the rising 3 method. These are two different formations. These consist of 5 candlesticks. Remember, of course, this is a simple tutorial to show you all the candlesticks that exist out there, and I mean all of them. But the main idea, what you need to understand, is that the more candlesticks you introduce into a pattern, that's why we will see patterns that are far more advanced, and it will help you much more to understand how trading works in by combining also some other theories that will probably give you profits. And I say probably because there are many other factors that we have already analyzed in this series. For this formation, we here consist of 5 candles. Remember, you must read the market always upside down. Do not look only the direction you want to see. You need also check the opposite. So for every pattern that goes with the downside, there is the opposite that goes with the upside. Now the market is going down. We have a strong bearish candle with a big body and 3 other ones that are inside this one. How can we conceive that? How can we understand the idea that the prices keep falling in a very fast pace, if we could say that? Eventually they stop at some point, they start the retracement, but they are not able to go so fast higher. I'm using the words fast and slow like an indicator, just to show you and make you understand that in the market there is a momentum. So the prices keep going down, they try to go higher, but check that each of this candlestick is much more weak. The main idea of the 3 falling method or the 3 rising is that you should see 3 much smaller candlesticks inside and one bigger one with big body that follows after the third one. Now the bearish momentum keeps higher and higher and higher, and the market of course goes down. Exactly the opposite. with the three falling method is the rising method. In the rising method, you will have an upside candlestick. Now, of course, as you can see, it's not always 100% the way you're gonna see it in the market. There are always spikes. There are some tweezer tops. There are some phenomena that you must be familiar with the market. You must be agile when you are looking at diagram, or when you are putting a stop loss. It should contain three smaller ones to the downside that all of them will include in the big one. Now, of course, this violates the pattern because the prices shoot higher. But for the down one, for the three falling method, this is exactly how you're going to see it. And exactly the opposite is the three rising method. You will have a bullish engulfing candles and three smaller ones that all the prices will include in the initial candle. We have the downside Tasuki and the upside Tasuki. They are both means that they are trend continuation. They are consist of three candles. As I explained before, sometimes there might be a gap between these candles, between any candlestick, of course. This means that probably when the information, when the minute change, because I had to go to the 1 minute chart, and where is the long liquidity, probably you will see that there are gaps between the candlesticks. So the downside, which of course it didn't confirm, it means that there are two engulfing candles and there is a gap between them in the prices, and follow up by an engulfing one, a bullish one. This means that the trend will continue go to the downside. And of course I found the opposite here in the upside, that shows that the trend will continue to the upside. You see that we have two bullish engulfing candles, and there is a gap in the prices, and there goes down. The main idea is that when for example the price is going down, this candle, the engulfing one, must close inside these two previous one, which means that the trend will continue to go down. Of course it didn't. Of course I explained that. It doesn't mean that it will always be guaranteed. And of course, when you are having so much liquidity as we are talking about Forex, it will be almost impossible to have gaps. Probably you will have gaps in the openings, or when there are different in sessions, or in big events of the weekends, and then you have the Monday opening. Well, actually it's not Monday, it's Sunday, depends on what country you are. Now, as we are talking, the markets are closed. Now, for the upside Tasuki, we have the two engulfing ones and a bearish one that the prices are included inside here. These are very rare, and if you notice, I have drawn these two lines just to hide some candlesticks behind them, just to show you the idea. They are very rare, and you will see them only when there is a great volatility in the market. We have two identical formations. The one consists of two candlesticks. It's called Bearish Harami. What does this mean? That for this given period in the 4 hours, we have an uptrend. We have a bearish candle with a big body that almost fits inside the entire previous one. This formation with these two candles, it's called Bearish Harami. We have a 3 inside out when the next candle, which is a different formation, consists of 3 candles. When the next, we have a big body in the candlestick, and the prices close significantly below the first one. This means probably that the bullish trend has come to an end. Next, we have the hammer. The hammer is a candlestick that indicates that the market, the downtrend, will come into an end. It's got a long tail and a body. how does this, how can we interpret this candlestick? If you zoom in the 1 minute chart for the given period, which will be with green, we'll see that the prices were, when this period opened, were going down, but eventually they were start shooting up and up, and at the end they form this pattern. Remember, when I change time frames, you will see different images, and this is very confusing in the beginning, but you need to get used to it. So this is the hammer piercing pattern. This is a very common candlestick formation, consists of 2 candles. Now the prices are coming down at this point, but eventually we have an engulfing candlestick that the closing price is more than 50% of the previous one. Now let's see that these were the price range of the previous candle. Indeed, the next candle in the opposite direction was bigger than the 50% of the previous one. Remember, you are seeing now live markets, and you see how confusing can that be as a definition, and how we can play with words. I mean, what does 50% mean and not 49 or 51 or 52? You need to understand the concept behind candlesticks. Do not use them as a rule, because we have already analyzed in our series. Nothing is written in stone. We are giving simple examples here. So we have the morning star and the evening star. These are multiple candlestick patterns. Remember, we won't go to the more advanced one in this episode. We will just explain the simple ones. And it consists of 3 candles. They are indication that the trend will change or reverse, and this is a morning star. Morning star means that the prices will change direction, will go up, and evening star, it means that the prices will go down. For the morning star, what is the interpretation behind the visual? Because we are in the 1 hour, you will see that the prices went down, but eventually they start shooting up, and retreat a bit, and then left go to the next one. But for the given duration, it means that the prices were balanced to a positive outcome. That's why this is a green body. Now in the 30 minutes I have spot 2 evening stars. It's exactly the opposite. The market was going higher, but eventually after this evening star, and these are the 2 others that should follow it, will go into the downside. This is also happened the same here. Now of course we don't have a morning star here, because this this shadow here violates it. But if it wasn't there, we would have an evening star, the price shoot down, a morning star consists out of this, and an evening star again. Remember what I've told you, it doesn't mean that they are 100% accurate. And this is the reason that I have opened a real market, to show them to you in a real market, and how you can and you understand the logic behind. The logic behind the mechanistic way of they work is that the prices indeed were going up, but at this point they were start reversing, and that's why they are calling evening and morning star. Next in our list we have candlestick formation that are consist of 3 candlesticks. They call the 3 white soldiers and the 3 black crows. By definition you can understand. The 3 black crows, it's when we have 3 candlesticks in a row after a trend that is coming up. It shows that probably the trend will reverse to the downside. Remember, I tried to find some examples here in real markets. The main idea is that there will be 3 candlesticks with very small shadows and wicks. I mean, they will have full body, and it means that the market will reverse to the downside. That's why they call 3 black crows. The opposites come with the 3 white soldiers. There should be 3 candlesticks with a big body and small tails and wick. That's why it's not very common to find them. Here is another example of 3 black crows, but it's already coming from the downside. Again, do not expect to find them exactly as you will see them. It's just an example. This means that the trend will reverse to the downside. The 3 white horsemen mean that the trend will reverse and will go to the upside. To never take into consideration and never, of course, use them to trade. You need to understand the psychology behind that. The psychology behind the 3 black crows is that for the entire 3 hours the prices were going up, even though they are coming from an uptrend. And the opposite, when the prices are coming from a downtrend, for the entire 3 hours, 3 bullish engulfing. They are not bullish engulfing, of course, in this case, but I'm just trying to show it you in the real market, because it will be confusing also in the real market. Now the prices, even though they were falling, for 3 consecutive hours they will keep shooting up. So it means that now probably the momentum will change. The market will reverse to the upside or to the downside. The black Marabozu and the white Marabozu. These are 2 candlesticks. They are 2 different. They have a big body and small tails. The black Marabozu means that the prices, after they were going up, probably will reverse and return to the downside. It is a candlestick with a big body. It means that the prices keep shooting up, but at this point we have an engulfing, a candle with a big body. It's called the black one, and the price is reversed. Now exactly in the opposite direction we have an engulfing, a white one at this point. It's got a big body. It means that the prices will probably go to the upside, and of course they did. Remember that I choose these patterns just to show you in the markets. When you are trading live markets, things will be rather different. You need to exercise your eyes and understand that every time they will be a bit different, but you don't have to worry at this point. Just keep in mind the basics. Next we have another common formation, 3 candlesticks. It's called 3 inside up. The prices are coming to the downside. We have an engulfing candle here, which indicates that the prices probably will continue down. But second, this is the formation. These are the 3 candles that gives the formation. The second candles goes closes in the upside inside the body of the previous one, and then what's happening? The third candle goes engulfing and goes outside the previous one, the closing one. Now also here we can see the 3 white horsemen. We have 3 bullish engulfing candles, which means that probably the prices will reverse. That's why I told you nothing is written in stone, even though in this case we have, or in many times you will see that probably you will have multiple patterns at one time frame or at another time frame, and this will make your trading easier if you have multiple signals, or a head and shoulder pattern that it's very clear here on the 30 minutes. But we will see more advanced pattern in this series. We have the bullish Harami. Harami means pregnant. It consists of 2 candlesticks. It looks like the previous one. Remember, it's very hard to spot them in real markets because the definition gives that there should be a down bearish engulfing with a very small shadow. But as you'll see in trading, it's impossible to spot a candlestick without a shadow. I mean, these are just range prices. This will consist of the next candle that will be part of this, of the previous one. Now you can see the body of this candle. It includes inside the previous one, but it's an engulfing one. This means that the there will be a trend changing. The down will become up. We have the Tweezer Bottom. It's another candlestick formation. It consists of two candlesticks. Now the trend was to the downside, and what happened that we have an engulfing candle here, and the prices were heating up. They didn't pass the previous top, but also they didn't go lower than the previous one. They have almost identical low prices. And now what happens? The prices shoots up. Again, keep in mind, these are just an example. A Tweezer bottom, it means that the prices will probably reverse to the upside. Next, we have the one candlestick. It's called inverted hammer. It looks like a hammer inverted. The prices are coming down. This indicates a bullish reversal, and indeed the prices were going to the upside. Again, these are just examples. So what does this mean? That the prices were at this point were going higher. Eventually they didn't manage to close so high. They got rejected, but they didn't reject it so hard. I mean, it means that probably the downtrend at this range is start to slowing down. Always use candlesticks with some help, either are indicators or whatever suits for you. Do not take them for granted. You will see millions of them in formation, and every time they will just giving you false signals. Next in our list, 3 outside up. This is another candlestick pattern, consists of 3 candlesticks. What is the idea behind it? We have an engulfing candlestick with a big body coming from a downtrend. The prices keeps going down, and at this point the prices shoots up. The next candle, it's an engulfing one, and it gives bigger range than the previous one, which means that the entire body of this candlestick is inside here, inside the second one. And then we have the third one, another bullish one, engulfing. It's the confirmation to go up. It means that the downtrend came into an end, and now probably the uptrend will start. The next pattern, it's a bit tricky. It's called on neck. It means that the prices will reverse. Usually I want to analyze the liquidity of the market and the volatility, but when we have low liquidity markets and high volatility, probably you'll see that there are some gaps between the candles. The closing price of this candle, for example, it might drop or slide a bit lower. Usually you will observe this kind of huge differences when we have the opening and the closing sessions. Like for example, if you see this part, we have just it looks like it appears like a line. It means that the prices dropped significantly, and there is a gap. Now what I did to show you this kind of on neck, I believe that we are checking a Forex market now. We are talking about the most liquid market, so apparently you won't see this kind of gaps, at least when you will entering in the daily charts. Probably if you go to much smaller gaps like the 1 minute, or there are some traders that even give the 10 seconds that you can check, you probably see it and you probably sit there. So the prices drop at this point immediately, so there is the gap. Ignore this shadow, drops immediately, and the prices shoot up. Now why it's called neck on? Because they share the same price. The closing price of this candle, which was a bearish candle, it's the same with the closing price of this candle, which is a bullish candle. I know it's a bit tricky, and you will see it in this case only, not only, but it's very rare. You will see it in markets with very low liquidity. Hanging man, a single candlestick. it indicates that the prices will reverse, will go to the downside. That's why it's called, it looks like someone hanging, if we could say that. Now, the prices after this engulfing candle came at this point out. Remember, if we change time frames, you will see completely different. So let's keep it simple and not make it more confusing. The prices at this point were falling down, but eventually they came a bit higher, but they didn't manage to close at a positive. I mean, it's still a bearish candle. I mean, the prices start at this point and came out at this point. It's got a body. Many give a definition. It might be the 30%, the 20%. Nothing is written in stone. Visually, you will understand as it will look like this. Do not expect to be exactly like the manual on the handbook, and that's why I always choose that in live markets. You will hear it very often, you will see very often. It's called the dark cloud. It consists of two candlesticks. We have a bullish engulfing one and followed by bearish one. Now what happened? The bearish one, after an uptrend, the bearish one, its cover, it goes more than 50% of the previous one and closes below. This means a probably trend reversal. Probably the prices will go to the downside. Shooting star, it's one candlestick. This is not a formation. It means that the trend will reverse. And see what happens here. The prices are going up, and at this point, what is the explanation behind it? The prices were going up higher and higher, but eventually they got rejected, and they keep retracing and moving to the downside. Eventually, the price didn't manage to go higher. That's why this is in this formation, in this single candlestick, it means that probably the trend will change, will go to the downside. Tweezer top. These are two candlesticks pattern. We see here that the trend is going to the upside. The closes, it shoots up here. And now the next candle is a bearish one. Keep in mind that both candles have the same high prices, and then what the market does, it shoots down to the opposite direction. This is a signal that most likely the prices will reverse. The uptrend will go to the downtrend. And now here comes our our last formation that we're going to see, and it's called mat hold formation. It consists again from out of 5 candles. It can be either bullish or bearish. Of course, it's not easy to spot it. Every time that we increase the number of candles in a chart or in a candlestick pattern, we're going to see that when we will check the more advanced pattern I have already explained in this series. You will understand that the thing becomes a bit blurrier, but let's keep this one. The mat hold is a bullish or bearish engulfing candle with a big body and 3 smaller ones. And again, we have a big bullish engulfing candle. Of course, the theory says that this candle should close above, but you need to understand that all candlestick is just a visual representation in a range of prices. They don't mean anything. I've said that many times. You can use them as signals to enter a trade. We will analyze more advanced pattern, but for now, in this video, in the entire video, I have analyzed around 30 of them. All of them that you will see outside. Also, there are patterns that it's much harder to see and identify. I hope you enjoyed the video. I know it's big, it's huge, but I had to do that in one video because in this series you will see all the technical, fundamental and any other analysis that you will find. Try to stay tuned. I'm not sure if I will be able to upload a video every week. Of course, for the series Forex Debunked, I will try to make a video every week. You can check the series. Now, in a conclusion, if we could say about the candlesticks, on how to use them, of course, the more candlesticks we add in a pattern or a chart, the more price range we cover, it's the better that will help in our analysis. A spinning top will be very useful when we are coming at a point to determine if we're gonna go short or long, because it means indecision in the market. Remember, for the given period, because if you change the time frames, then you're gonna see very, very different visual representations, and that's why many people find hard to trade, because it's a hindsight. I can guarantee it is not. It takes a lot of time to master. I cannot agree with that. I cannot disagree, sorry, with that. Many people claim 5 years, 3 years. Unfortunately, I do not have a number. I don't have a number to tell you exactly how and at what point. For sure, since you choose to trade, you are in the, let's say, in the 10% of the total population that manages to understand that there is more than a simple job 9 to 5. Of course, this is not easy. Pushing a button and executing an order in the market, it doesn't mean that you find the golden egg, and this is the hardest part, that even if you start trading, probably you'll get disappointed, because you will find many people out there claiming that they can beat the market. We say that many times in our video. Now this is another tutorial video with candlesticks. A candlestick, you have to keep in mind that it comes from the 18th century, from the 1700s. So yes, it's awesome. It's really good because it can give you at the same time for price information like the open, high, low, close. So you can work with the data. Most of these candlesticks, at least all of them, if you could read a bit more, if you want to make let's say your own research at the topic, you'll find out that they are mentioning to the daily. Imagine that a rice merchant seeing the prices at the closing and at the open. For example, if you see 3 bullish engulfing candles, the 3 white horsemen, everyone, because candlestick, it's another psychological game, everyone will come into their mind that probably the prices on the 4th day will continue going up. The opposite, if someone at that age was seeing that for 3 consecutive days the prices were going down, 3 black clouds, so he probably understand in his mind, or here, I don't know, but I think in the 1700s they were only male at that point, not in the general population, but you understand. He psychologically, given the idea, he will say that probably the prices will keep falling. Remember that you are not trading the market. Of course, there are some candlesticks. Many people, I told you that they do not use them. I will go deeper into some techniques that we won't use candlesticks in this series. Again, thank you very much for watching this video. I know it is a big video, but most of the tutorials will be at the same pace, because in this channel we want to educate people regarding Forex, because everyone and most of them outside believe that it's a scam, and it's not a scam. There are people that have dedicated years of research, and I can guarantee they are having a very good results. Thank you very much for watching. Thank you for your support. I hope I'll see you in the future. Trade safe.